Which brings us to index funds and why I think they're a good way to go for beginners. An index fund can do the same thing as an actively managed fund, except it simply mirrors a portion of the market, or in the case that I recommend, the entire market, and then you can benefit from that same fund analogy where if some companies do poorly but others do well, you're still going to grow over time, but their fees are exponentially lower. In fact, if you look at VT Sachs, which is Vanguard's total market index fund, their fee is 0.04%. So instead of 1% or more to an actively managed fund manager, you're paying 0.04%. So if we use our previous example, if you're taking $100 a month for 35 years and that ends up going at an 8% interest rate or growth rate, you end up with about $206,000 at the end of that. Well, if you're removing 0.04% as a fee that you pay annually, then your returns over those same 35 years is actually about $205,000. So instead of losing 40 grand to a mutual fund manager, you've lost $1,000, maybe $2,000 over that same period of time to pay for an index fund. So your growth potential is about the same as far as your total return, but the amount you lose in fees to an index fund is way less, way less. I would always do it this way. So for me, that's the huge selling point of index funds over mutual funds that are actively managed. Now, there are different kinds of index funds as well. You can have index funds that are just indexed towards a specific industry. So I again recommend something like an index that follows the S&P 500, or even broader than that, like a VT Sachs. VT Sachs, VTSAX is just the ticker symbol for this mutual fund that Vanguard offers that mirrors the total market. And another reason to go with index funds is because Warren Buffett bet hedge fund managers that the S&P 500 would actually outperform their investments over 10 years. And he got people to accept his bet of $1 million to try to beat the market, and over 10 years, the S&P 500 index outperformed the hedge fund managers. Now, there were years where the hedge fund managers did better, but over the course of the long haul, the full 10 years, they couldn't beat the market consistently over time. That's what managers try to say. They say, we'll pick things that are gonna beat the market. Hey, any given day, month, or year, they might. And that's what they're gonna point to say, well, this is how we've done it for this year and that year, and so we're super successful. But over the course of your retirement, like preparing for 10, 20, 30 years, no fund manager is going to consistently beat the market over a 30-year period. At least a very, very small portion of them will, and the odds that you've picked the one that will are very low. So it's better to just stick with index fund investing for the long term, and that's a more secure way to guarantee growth over the long-term investments. And who am I to argue with Warren Buffett, right? And if you want more on this topic, you can watch the full video here, or you can go to my playlist down there, or to learn more about personal finance, investing, and building wealth, you can click below. And don't forget about my TikTok and Instagram at ThomasKnappFE. Find your path to financial freedom. Stay empowered, and we will see you next time.